Have you ever stared at a stock chart and wondered, could this tiny Rs1 stock really become a Rs10 wealth creator someday? Trust me, you're not alone. I've had the same thought, and history shows it's not about magic or luck. It's about understanding patterns and business fundamentals, spotting the real clues that predict long-term potential. Let's break this down with a real-life example. Nahar Polyfilms Ltd. Now, before we jump in, quick disclaimer. This is just for educational discussion, not investment advice. I'm not a CBI-registered analyst, so please, always do your own research. Alright, here's the deal with Nahar Polyfilms. They're a big player in BOPP films. That's the stuff in food packaging, tape, labels, you name it. They just doubled their capacity from 30,000 to 60,000 tons per year. The promoters? They own a whopping 71% of the company, which shows some serious skin in the game. 91% of their sales are domestic, 9% are exports, and they've got low debt, steady dividends, and solid sales growth. Plus, they're connected to the bigger Nahar Group, so think financial flexibility and group synergy. Now, here's where it gets interesting. There are 9 prime factors I look for in any potential wealth multiplier. 1. Big promoter holding. Check. When the owners have a huge stake, they want the business to win. 2. Group synergy. Cross-holdings and resource sharing make them stronger. 3. Recent capacity expansion. That's a growth signal. 4. Low debt. Less risk, less interest headache. 5. Steady dividend payout. Sharing profits, not just hoarding them. 6. Diversified clients. No single customer calling all the shots. 7. Balance of domestic and export sales. More ways to earn. 8. Trading below book value. Often a sign it's undervalued. 9. Consistent long-term sales growth, 10-year CAGR of 8%. But just ticking boxes isn't enough, right? I also look for 9 wealth-creating symptoms, the signs that often show up in companies before they become multi-baggers. 1. Capacity utilization keeps rising. Doubling lines means more revenue pipes. 2. Debt is on a downward trend, safer and more resilient. 3. Promoter holding is stable. No dilution, no funny business. 4. Products are relevant in a growing industry. Flexible packaging is big right now. 5. Dividend culture is strong. That's predictable income for investors. 6. Market diversification, not putting all eggs in one basket. 7. Expansion funded by internal accruals, not excessive borrowing. 8. Resilience in downturns. Even after 3 tough years for the share price, their TTM profit shot up 253%. 9. Valuation comfort. Buying below book value can mean downside protection. So, what's the takeaway? No stock is ever a guaranteed multi-bagger. But when you see a company ticking so many boxes, promoter commitment, industry relevance, healthy finances, expansion mindset, and an undervaluation opportunity, the odds are suddenly in your favor. Now let me flip it to you. Would you buy a stock trading below book value with low debt? Is high promoter holding a strong enough trust factor for you? How much do you care about dividend history when picking stocks? Let me know in the comments. And remember, this is all for educational discussion, not investment advice. I'm not a CBI-registered analyst. Always do your own due diligence before you invest. Thanks for watching and happy learning.